Following the conversation that we have had regarding taxation, which is a major eroding factor, there are a number of things that you can try to do in order to avoid taxation in the future. One of the best things that you can do moving forward is instead of having to put all the money into a traditional 401k where the money goes in pre-tax and then the money grows tax deferred, but then when you retire, you'll pay taxes on everything coming out of it. You may be able to split the contributions with your employer if you happen to be a W-2 employee and you work for a firm that offers you a 401k. You may now have the opportunity to also put a portion of it into a Roth 401k. If you put the money into a Roth 401k, obviously you have to remember that the money that goes into that Roth 401k will be fully taxable at the time that you make the contribution. But then the growth will be totally tax-free, for the rest of your life. And usually when you get to age 65 and you retire, then you would convert that Roth 401k to a Roth IRA. So that way you're going to have a lot more flexibility with that plan than if you leave it in the corporate structure where you worked for a number of years. Now, the benefit of the Roth IRA in this situation would be that the money goes in after tax. You still have the rules of engagement of age 59 and a half, unless you fit a specific distribution flexibility there or requirement. Then obviously you're going to have to pay that 10% liability. But once you reach age 59 and a half, you should be okay. And then the growth of that money would be totally tax-free. One of the major advantages of a Roth IRA versus a 401k is the 401k has the required minimum distribution at age 73. A Roth IRA does not have a minimum retirement distribution. So if you want to scale your retirement distributions, you can put money into a Roth IRA and allow that money to continue to grow tax-free, not tax-deferred at this point, because it would be tax-free past age 73. So you can start taking distributions into what we call the go-go years, the slow-go years, and the no-go years, into the 3 decades of planning for retirement. And between 65 and 75, you start taking out, some of your pre-tax or traditional IRAs or 401ks contributions. You take them out of deduction distribution depending on your tax liability, and you may be able to offset some of that tax liability by taking distributions from your Roth IRAs. Once you get into your mid 70s to late 70s, perhaps early 80s, then you can start switching to Roth IRA distributions, because I think we all understand that taxes in the future are going to have to be a lot higher than they are today, because otherwise this country is going to go bankrupt. So you need to try to understand how to play the distribution game in retirement. It's not just retiring and taking money out of your qualified plans. You have to understand the timing, the taxation liability, the potential for additional taxation, any penalties that you may incur depending on when you take the money out, and how do you combine that with a tax-free distribution that you could use Roth IRAs, you can use certain life insurance contracts to provide for that. Municipal bonds also are tax-free if you happen to own them in the same state that you live in. But there's another issue with municipal bonds that we'll discuss in the next video. So traditional Roth IRAs, the way that they have been designed under the law, may be a suitable opportunity for each and every one of you that wants to do some tax planning today in preparation for tomorrow. So if you want to discuss this further, please feel free to reach out. My name is Bert Salazar, and you can call me at area code 888-IRS-0108, 888-477-0108, or you can send me an email at bertdrt@gablestaxgroup.com, and I'm looking forward to seeing you on our next video. Thank you, and you have a great day.